Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Cheesecake Factory stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. The Cheesecake Factory is a restaurant chain and distributor of cheesecakes. The company operates 220 full-service restaurants, 206 under the Cheesecake Factory brand, and the rest under the Grand Lux Cafe brand. The company also operates 2 bakery production facilities, one in California and one in North Carolina. You can also purchase its cheesecakes and other baked goods in Barnes & Noble stores. The first store opened in Beverly Hills, California in 1978. Let's get started with the model. This is a small cap company, 1.9 billion market cap. They're trading at $41 a share and they have 46 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. The company does have positive free cash flow every year, but it took a big dip in the trailing 12 months. Net income is the profit and loss on the income statement. It's revenue minus expenses. They did have pretty good net income in 2017, 18, and 19, but negative in the trailing 12 months. Revenue is the sales for the year. It did grow from 2.3 billion to 2.5 billion, but then took a dip as expected in the trailing 12 months due to COVID. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The difference between those two numbers is their gross profit, and that was the lowest in the trailing 12 months. Below that is operating expenses. Then below that is operating income. The company had negative $78 million of operating income due to weakening sales from COVID. They also have a good amount of debt on their books. So below operating income is the interest they pay in their debt. Then there's other income and expenses. That's usually investments or impairments. Then they have taxes. And then the bottom line of the income statement is their net income. And they had negative net income in the trailing 12 months, but they did have positive in prior years. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. So the way you calculate free cash flow, it's operating cash flow minus capex. So they did squeak out a small positive in the trailing 12 months. They did have much stronger free cash flow in prior years. Their peak was $185 million in 2018. The company used to pay a dividend, but they suspended their dividend payment in 2020. Another way to reward investors is to buy back stock, and this company buys back stock every year. $123 million in 2017, $110 million, then $51 million. Buying back stock lessens the shares in the market, which makes the current shares more valuable. In 2017 and 18, the company issued just about as much debt as they paid off. In 2019, they issued $335 million of debt and paid off $55 million. So they increased their debt load $280 million in 2019. The most important part of any business is their operating cash flow, because a company does need to generate positive operating cash flow, else it does not have much of a business, because you cannot rely on debt and equity financing to run your business in the long term. This company does generate positive operating cash flow, and of course it was weak in the trailing 12 months due to low sales from COVID. But they did have positive $70 million of operating cash flow. To calculate operating cash flow, you start with net income. That was negative $172 million. Then you have to add or subtract the non-cash items on the income statement. They had $93 million of depreciation. That's a non-cash expense. That brings down your net income, but you have to add it back on the cash flow from operations section. They also had a $212 million asset impairment. That's when you have to write down the value of an asset on your balance sheet and pass through an expense onto your income statement, because you should not inflate your balance sheet. The dollar amount of your assets should be accurate. Even though on the income statement, the company reported negative $173 million of profit, That's accounting loss. It's not actual cash. They did generate $70 million of cash flow. Let's look at their capital structure. $570 million of equity, $1.6 billion of debt. So they're about 1/4 equity, 3/4 debt. And their WACC is 8.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $1.8 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.7 billion. We divide that by 46 million shares. And we get a calculated stock price of $36.46. They're trading at $41.22, so they're trading at a 13% premium. It's a sell according to the model. Simply Wall Street values the company at $31, so they're also saying it's overvalued, even more so than me. The stock was trading in the low 50s at a couple of points the past few years, then took a big dip in March like everything else, but it's come back up almost at where it was before the crash in March. The stock is trading at a pretty good discount relative to its all-time highs, but it is trading at a premium relative to my model and according to Simply Wall Street. In May of last year, the company announced that it was suspending its dividend payment. This is a good idea. A company should not pay out dividends during a difficult time like COVID. The greatest disservice you can provide your shareholders is going bankrupt and them losing everything. The company has a pretty high beta, 1.71, so the stock moves a little less than 2 times the market. And the stock has only gone up 4.5% in the past 52 weeks. A lot worse than the S&P 500, which went up 13.5%. And the low was 1450, the high was 43. The stock is trading above its 50-day and 200-day moving average, so it does seem to be in an uptrend. And about 1 million shares are traded each day for this stock. And of the 46 million shares outstanding, 42 million are on float, so that means they're available for investors like me and you to purchase. And almost all the shares outstanding are held by institutions, so they appear bullish on this stock. And it has a really high short percentage. 30% of the shares on float are shorted. So I think the market is saying this company may struggle or possibly go bankrupt. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $16,000 today. If you did not reinvest the dividends, you'd also have about $16,000 today. So if you invested $10,000 in this company in January 2011, you would have been down to about $9,500 after a few months. But if you would have held on, you could have sold at over $20,000. Then you would have been below $10,000 in the beginning of 2020. But if you held on, it would have came back up into the green. So it's not the best return on investment, only 4.7% annual return over the past 10 years. BlackRock is their biggest shareholder, then Vanguard, then Kayne Anderson. Then the CEO of the company, David Overton, owns about 7% of the shares. Then Barron Capital, 3.7%. Let's look at their financial ratios. The average PE in the market's 11.3, the median is 14.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price of sales is stock price over sales per share. They're at 0.9. So investors are paying 90 cents for $1 revenue. That's a really good price to sales ratio. Price to book is stock price over book value per share. They're at 3.3, so they're between the median and average. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $572 million of equity, but $135 million of tangible equity because they have about $440 million of intangible assets on their balance sheet. ROE is net income over equity. They have negative net income, so negative ROE. Current ratio is current assets over current liabilities. They can only cover 40% of their current liabilities with their current assets. Their current assets are $58 million of cash, $94 million of receivables, and $47 million of inventory. So the company will need more debt to run their business over the next 12 months because they had hardly any free cash flow and they have negative $370 million of working capital. Working capital is current assets minus current liabilities. The best way to look at ratios to compare them to similar companies, I've done videos of 12 companies in the same industry as Cheesecake Factory, And if Cheesecake has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE because they're negative. They have negative earnings. They are a lot better in price to sales. They're a little worse in price to book. The entire industry is doing pretty bad in current ratio, including them. Negative ROE, so that's bad. They're a little lower in debt than average, and they have a pretty low market cap, 1.9 billion, average of 30 billion, and they don't pay a dividend. So to summarize, I have them trading at a 13% premium. So it is risky because things aren't back to normal, and it could take another few months or maybe another year or two to get back to normal. No one really knows. So the company may struggle for another year or two, but they do provide a great product and they have a decent brand name. So it's not a bad investment, it's just a little risky at this point. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.